right, good morning. I'm Matt Diersen, Extension Specialist here at South Dakota State University, and I'm going to start. All right. Owner Matt, am I sharing the screen that looks like a title screen?
Yes.
All right, good. Um, we're going to take a quick look this morning at cattle market risk management. Heavy focus here is on livestock risk protection, LGM, or livestock insurance products that sort of gained a lot of popularity, and they're kind of the hot risk management tool right now on the cattle side of things. We'll take a look at some of the related market situation, especially the tighter supply of cattle in that regard as well. So we'll just get started. If you're not aware, I do write an occasional column called "In the Cattle Markets" for the Livestock Market Information Center. If you'd like access to that, please reach out. We'll get you that because that's where I covered some of the mid-year cattle inventory and cattle on feed situation. My contact information is on the back of the old red book there. Cattle inventory July 1. So we had a mid-year cattle inventory report this year, which was missing last year. You can see here for the total cattle inventory, down slightly from 2 years ago. So we don't have last year, but from 2 years ago. So just big picture, fewer cattle and calves, all classes, all types in the United States right now. A couple of big categories that are just interesting to take a look at. Here's heifers held outside, or heifers held as beef cow replacements. So if we were in any kind of expansion, you'd see that number ticking up. Continues to be down, and down a little bit from where it was 2 years ago. So no big sign of expansion that way. The feeder cattle supplies outside of feedlots. So this is the July 1 number. You can see here, this would be a record low July number of 34 million head. This would be a combination of slightly smaller calf crop and things, but also a slight decline in number of cattle coming in from Mexico, feeder cattle replacements coming in from Mexico. So that combination of things gives us sort of a record level of tight calf or feeder supplies to serve as replacements in feedlots. So that's really what's giving a boost to prices. And until that turns around, you'd expect to see relatively high cattle prices to continue. Maybe one thing, slight indication that might be, am I hedging enough? Might be giving some indication that some of the contraction is maybe over. It's the heifers on feed as a percent of the total number of steers and heifers on feed, the heifer mix. So strictly just in the cattle on feed, they survey how many steers, how many heifers, and this mix. And you can see it's got a pretty consistent quarterly behavior or pattern to it. Let's see if we can grab a highlighter on here. So normally you'd have a low and then seasonal increases or seasonal variability in this thing. And last quarter, so April 1st, this is a fairly tight or maybe a more dramatic shift in terms of a smaller number of heifers in feedlots. So the tendency was, hey, maybe we're going to hold back some of these heifers. Some of those heifers were maybe going to be replacements. Maybe we're going to go to the feedlot. And then that number ticked up a little bit as we went into July 1. But if you compare that to, say, the previous July 1s, it's not near as high of a percent. So maybe there's a slight indication that you've got a little bit of a start to expansion, and that would be the one indicator, or this measure would be the one indicator to kind of keep an eye on going forward as far as a leading indicator of expansion occurring in this cattle side of things. Calf prices. Just want to highlight this. This is the 5 to 6 weight steers reported by AMS sale locations in South Dakota. You can see that all around about end of May, moved over that $400 mark. The last 2 weeks, there's not been 5 to 6 weight run through the South Dakota AMS reports, so there's not a new or more current price to show here, but the basis levels implied by the forward markets, we're showing stronger basis level on calves versus the feeder cattle market compared to last year at this time. So another weak indication of the strength of prices. Big picture, December live cattle futures here. This is a seasonal overlay. We grabbed this chart from our Bloomberg terminals downstairs. So you can see that, currently for all of this calendar year, 2025, December live cattle futures have been trading higher than they have ever traded before. So that combination of tight supplies of tight beef supply, if you can think of it that way, and strong consumer demand is keeping that price level high, and that carries over to the other markets. So here's feeder cattle. Here's the November feeder cattle futures, and this picks up seasonally. So this is overlaying all the November only futures prices over the last 10 years. And you can see that roundabout in February, there was a little time period in there. Get that laser back here. This time period right through here. So that was January, February was the only time that the 2025 contract price wasn't above last year's November 24 contract price. Other than that, we've had all-time record high price levels in the futures market for the November contract. And we knocked out the previous highs from 2013, 2014, 2015. Most of those got knocked out here in the last 2 years in the feeder cattle market as well. So high prices are here. Just some observations on that. The volatility in the cattle markets. If you log in or have a login account with the CME Group or the Chicago Mercantile Exchange website, you can access CVOL there. So I grabbed a CVOL chart comparing live cattle and feeder cattle volatility just the last year, just to see that that volatility predominantly on the nearby contracts is in that 18 to 19% right now for both feeders and fats. You can see that's up a little bit from say earlier in the summer, or if we go back to May, you were down around 12% on both those contracts. So a little higher prices, or as the prices continue to rise, you've got a little bit of an uptick here in volatility. So that's pushing up the cost of some of the insurance products as well. Now, on to insurance, just highlight a couple things with livestock risk protection, or LRP. This coverage is still available for fed cattle, feeder cattle, and swine. Price insurance is similar to buying put options, and the coverage. This is the highlight here. The coverage is 13 to 52 weeks. So focus on that shortest duration. The shortest coverage period you can get is 13 weeks. So maybe that's really good for a feedlot situation, but not so good if you're looking at a short run calf price situation or something like that. The big deal in the LRP has been the increase in the subsidy over time. So prior to 2020, it was a very low subsidy, but now that subsidy is fairly high. Most of these products, or the LRP products, all settle to cash prices. So a little different between feeder cattle and lean hogs and fed cattle, which are still the futures would settle a little bit differently there. And then big selling feature of LRP is you can cover a small number of head. So those are commonly known things. Here's that subsidy table. So prior to 2020, it's only a 13% subsidy. But since September 14th, 2021, that subsidy, especially at the low end, is 55%, but at the high coverage level, 35% subsidy. So that's a substantial subsidy, really giving LRP a cost advantage relative to outright purchasing, put options to cover downside risk protection on feeder cattle and fed cattle. What are some new things happening or some concerns with LRP? First, the price adjustment factors in there don't even come close to what the market situation is right now. So the price adjustment factor for a steer weighing less than 600 pounds is 110% of the feeder cattle futures price. That would imply a 10% premium for calves in this part of the country for steer calves relative to the feeder cattle index. Well, it's more like a 40% right now, given the basis levels implied by the market. So price adjustment factor really doesn't reflect the risk and the price differentials for the calves that it used to reflect 15, 20 years ago when this started. There were some changes announced for this fiscal year. So the cattle LRP runs on a fiscal year basis. So July 1 through June 30th. So starting with this current fiscal year, 2026, there's some changes for contracted cattle. So if you buy cattle on a forward contract basis, it looks like you can, or this would be my understanding, you could purchase LRP on cattle that maybe haven't been delivered to you yet, but you have contracted to purchase. I think that would be the biggest single change along those lines. There's some changes for dairy crosses, both for unborn calves and also for cull cows that can be sort of cross-hedged against LRP on the fed side. And then a large change in some people's mind is a subsidy capture is now prohibited. What is a subsidy capture? Well, with a high subsidy level on the premium, reducing the effective cost of the coverage, there would be an incentive if you were just looking to take the subsidy and run. You could buy LRP, and then the simplest way to do it would be to sell a put option and basically offset the coverage and pocket any differential. That type of behavior is now explicitly prohibited in the contract. Some of the earlier iterations of LRP and some of its predecessor tools were very explicit about prohibiting offsetting and making trades that were would in any way sort of give you an advantage and let you take advantage of a subsidy while exposing you to risk. Now, I'd heard about subsidy capturing predominantly among hog producers because they have large forward contracts. So most of their production risk is, or all their price risk is covered by the forward contract. So they would not have the downside risk that the market, someone exposed to the market would be facing. So that was the only place I'd really heard about actively exploring subsidy captures, but perhaps it's been more widespread. There's some research. I was at conference, the Ag Econ conference in Denver this last month. So I heard some presentations from the University of Georgia and Utah State University, both looking at different aspects of the subsidy capture. The Georgia stuff looked and kind of delineated clean subsidy capture, just selling a call, but then also they call it dirty subsidy capture, using a combination of a short put or a synthetic put strategy. And depending on how you read the news releases, the policy, and the handbooks, a little bit of discrepancy between what may or may not be explicitly prohibited. But looking at the policy wording and the handbook wording, most of the clean and dirty might be prohibited or at least heavily discouraged going forward. But in both cases, the Utah data or the Utah study, for example, did a lot looking at the dates where LRP settles and seeing if that was, or noticing a pattern there that there were more futures and options volume tied to end dates for LRP, signaling that maybe this is a way that people are targeting or using the subsidy capture. The same with the Georgia stuff. Similar approaches. They were using the commitment of traders data to try to say, hey, here's an increase in commitment of trader volume tied to or associated with the increase in LRP volume. So there's some evidence in both cases that there may be something there, but both were a work in progress as well, and both found around $100 million of possible subsidy capture there. What I've been looking at too is that minimum duration of 13 weeks, that last bullet point there. If other things are prohibitive, you might want to think about some ways to upgrade instead of rolling. It would not prohibit you from buying additional puts. You just couldn't offset or roll off your existing LRP coverage cleanly. So it's something to keep in mind there as well. As far as big picture trends for feeder cattle here, so when that subsidy took place, or prior to that subsidy, so the first, look at the most recent 10 years of data here, but 2016 to 2020, very low volume, good volume in South Dakota, but the volume really picked up when that subsidy came into play. So the subsidy went from you'd be indifferent between puts and an LRP to, hey, LRP is just a no-brainer as far as if you're going to cover some risk. So in 21, 22, and you can see really in 23 and on, huge volume increase nationally and in South Dakota for the number of head covered. So got over 6 million head covered last fiscal year on feeder cattle. Here's the spatial or the regional breakdown of where that would happen. So I think of big cow-calf states, Texas, Nebraska, South Dakota, all with big LRP head covered. One state that didn't make the top of the list would be Missouri has a large cow-calf. Is a large cow-calf state. They don't make the list here. They're lumped into other, but you can see that the major cattle states that you'd think of having feeder cattle, you've got good usage in terms of LRP coverage. Fed cattle, a little different story. You do see the same relative increase in use of both LRP and LGM, or livestock gross margin insurance, on fed cattle. But I'll show you the breakdown of where that's occurring. It's a little different story and much smaller number of overall head covered. For fed cattle, no surprise, you do see more usage in large feedlot states. So Nebraska, Kansas, Texas, and Iowa, Colorado are in there. I put South Dakota in for perspective. We're not a giant feedlot state, but there is some feedlot usage of LRP. And as far as LGM goes, yeah, this Pac-Man looking character here, all the volumes in Texas. So there's about 20 different policy users that are accounting for all that head. So one set of feedlots must have the process figured out down there that works for them, or there's some other issues or reasons for that popularity of LGM in Texas relative to all the rest of the states in the nation. So continue to see that pattern. For perspective, here we've got the calf crop in the U.S. and South Dakota. So just to see how big is LRP usage relative to the calf crop across the U.S., about 18% of the head would be insured today relative to the size of the calf crop. In South Dakota, is closer to 41%. So fairly strong usage in South Dakota. And then relative to placements into feedlots, so the full number of placements during during calendar year 2024 is in there for the U.S. and South Dakota. So you can see that insurance use as a percent of that, 10% for the U.S. and 17% in South Dakota. Last couple things related to this would be feeder cattle sales volume, just to show that July was a big sales month in terms of feeder cattle volume across the U.S. So this is U.S. numbers here. You can see that fairly large spike relative to the 5-year average. And the biggest share of that, so the big gray bar or chunk of the gray bar there, was video auction sales. Those sales occurred in July, but which is a little bit higher than the last couple of years. So fairly strong video cattle usage this July. But that doesn't mean that those cattle were placed. It's predominantly picking up delivery or forward delivery of or forward sales of feeder cattle to be delivered later. So huge spike in October. So the sale took place in July for delivery. October, predominantly looking at less than 600 pounds or calf weight when you get into October and November. Um, so even though you had large video auction volume, didn't mean placements, but it does mean a fair number of cattle would be delivered at a later time. Same thing happens on the fed cattle side of things, just a longer run look. The green line down here at the bottom is forward contract volume, has stayed fairly consistent, crept back up here for most of 25 to be around 10% of fed cattle volume as well. So some high points of LRP and some of the changes. If you've got some questions on that, I take any clarification questions now. Otherwise, hold those other questions till after the other presentation. And my contact information if you'd like to follow up with this stuff. And check the chat. Okay. If you do want to post a question in the chat or save questions till the end when we turn recording off, feel free to do so. They're not asking questions. That's fine. Matt, do you want to, can you share on your end? There we go.
Yep. Can you hear me okay?
Yeah.
All right.
And the slide, I think the slide looks good too. So,
All right. Yeah, so I'm Matthew Elliott. I'm an associate professor here in the Ness School of Management and Economics. I focus on agribusinesses, contracts, risk management, particularly in the grain markets. I'm going to show an interactive app that we have that we're updating and continue to add features to. You can follow along. The app is at agland.sdstate.edu and then /grain. Taking a while to load with the Zoom, but that's where it is. I'll just run the app here locally. But that's where the URL is if you want to check it out. And so the app, we've covered different aspects of grain markets and grain market analysis. We update it. But right now what we have in there is kind of talking about supply demand currents and historical, looking at the export markets, doing some price analysis, looking at some production analysis and so forth. And so I'll just kind of walk through some of the features in the app and talk about where we are currently, specifically in the corn and soybean markets. So if you go hit the corn and you go corn supply, we just recently had on Tuesday the latest August WASDE report, or the World Agriculture Outlook Board from the USDA puts out their monthly forecast. And this was really the first forecast where they updated yields and updated acreage to kind of predict what kind of supply we're gonna have this fall and for marketing and demand for next year. So overall, if you haven't heard, the report was very bearish to the corn market. First of all, we had a high amount of planted acres going into the season, or we expected that at 95.2 million acres for planted corn acres, but that was actually increased about 2.1 million acres in this latest WASDE report, or about up 2.2%. But the big kicker on top of more planted acres was they raised the yield per acre estimate from 181 bushels per acre from the previous report to 188.8 bushels per acre, or about 7.8 bushels per acre more. Um, and that's on the account of having a pretty mild and good growing season with not a lot of adverse weather or droughts in the general production areas. And so that was kind of what was behind that. They did lower our beginning stocks, or the stocks that we plan to that in with last year and carry into the next year that can be part of supply. They did lower that, so that helped a little bit with the offset, but not nearly to the extent of the increase. And so overall, this last report added about 1 billion bushels more of supply for corn than we have. And historically, for comparison's sake, the 97.3 million acres is very large. You'd have to go back to 2012, 2013 to find a similar number. And the area harvested is large, reflective of that too. The yield obviously record large. So all these are very bearish types of things for more supply and different things like that. So you can look at some of these charts in more detail. You can also look at historical years. In here, I'll switch to the demand table now. And so with the additional supply, typically if USDA increases supply, then they'll increase demand because, right, prices going down, we expect demand increase. And alternatively, if production went down, then they would decrease demand in order to fit all of that in. But so what they did on the demand table, given the larger 1 billion bushels in supply, is they increased feed and residual by about 250 million bushels. They increased ethanol production 100 million bushels, a little bit on the food and seed, expecting more exports. So the previous export forecast for this upcoming marketing year was 2.675 billion bushels. They increased that 200 million bushels to about 2.875. So expecting to export a lot more corn than given this larger supply. And you can see how these estimates changed. And again, we'll get these monthly forecasts for this upcoming year marketing year, for every month going forward. So this data will be updated when we get those. Just by historical comparison, so this is going to be one of the largest feed and residual numbers that we've had. We've had a larger ethanol back in this 2017, 2018 period, but still pretty large, and so forth. And you can see exports, that would be the 2.875 billion bushels of exports would be one of the largest we've seen going back, to 2008, 2009. So pretty hefty export market that they're trying to build in there to kind of remove some of this demand. Ultimately, when you take that supply, what we have, you take the demand, then you get what's left over, the supply minus demand, which is your ending stocks. And ending stocks to use ratio is what the market really kind of watches and covers, because it's very predictive of what price is going to do. So when you have low ending stocks to use percentages, then you typically have higher prices. Conversely, when you have higher ending stocks to use, you have lower prices. And so when you figure out, the previous July estimate with that 181 bushels per acre yield, lower acreage, we were looking at with the demand about a 10.8% stocks to use on corn, which is fairly low historically speaking. But with all that new demand, we're going to be carrying over or with all that new supply, we don't have enough demand to even offset that. So we're expected to increase our ending stocks to use percentage at the end of the next marketing year to 13.3%. And so, on a nominal basis, that the ending stocks they're showing right now is about 2.1 billion bushels. So that would be pretty large, not nearly as bad as this 2016. So we have more demand, at this point in time. So a little bit that, our stocks to use ratio isn't nearly as bad as it was, say, during this middle 2015 to 2018 period when we were up at 15%. But again, there's a pretty hefty export market built in there that we'll see if that even materializes or not. So as I mentioned, stocks to use, any stocks to use and price, futures price is pretty related. So we have stocks to use percentage here on the x-axis, your futures price on the y-axis for corn on an average basis for the month. This is for the month of August. So with a 13.3% stocks to use, we would predict basically a 411.95 futures price. The average trade price for August right now is about 389, $3.89 per bushel. So we're about 22 cents below where we would expect, given that historical relationship between stocks to use. And a little bit that could be related to all this trade uncertainty with tariffs and so forth. And so we're a little bit lower than for a price. And also, we've seen the corn market after the bearish report come back and be positive the last couple of days. So it's a little bit kind of coming back to more where we would think, given our current stocks to use level. So when we look at the export front currently for this current market year, we have about 2 or 3, 4 more weeks. We've accumulated about 2.5 billion bushels in exports, which is actually above the estimate for this ending this market year at 2.47 for USDA. So they'll probably have to come up a little bit on that number. But if we're going to meet that target of 2.8 that we need to get shed this new big supply coming, we're definitely going to see another big export program going through the year. Largest corn export destinations typically are Mexico, Japan, Colombia, Korea, South Korea, and so forth. And so this is the weekly USDA data on exports, and you can look at where we are at relative to those demands and this type of export analysis. Just real quickly on the production, we do show yields in acres by the national numbers, what the trend line yield estimates and looking at next year. But just for South Dakota, for all extent and purposes, I mean, our yield and corn yield is expected to be about 2 bushels per acre higher than it was last year. Right now USDA is forecasting 168 in South Dakota for 2025, when we had 166 bushels per acre in 2024. Our acres planted compared to last year are up about 600,000 acres. So we're at 6.7 million acres versus 6.1 million acres. So a lot more corn in the South Dakota region as well as in the Corn Belt. Now just turning to kind of the futures price and futures market and where things are at. Currently this is the continuous rolling contracts, so the spot price of futures contracts. So right now about 378 we're trading. The 52-week high back here in February was 502, 504. So if guys made those hedges or did a lot of hedging, before they got the corn in the ground, then they certainly, and before all the tariff talk and things like that started to materialize, then they would have been doing, feeling pretty good about their marketing. But if they didn't, then, that was obviously a short-lived missed opportunity. As you might recall, last year we had a big yield number here in the fall WASDE reports that caused the markets to decline quite a bit after that August report. The subsequent reports and the January report were kind of surprising because that big yield that they were expecting turned out to not be as big. So USDA kept revising it downward. They were at like 183, and then they went down to like 179 by January. So that helped improve prices. But then we had all that tariff talk. We saw, multiple days of pretty good declines during that period with uncertainty with trade. Then we had the good growing season, and that's just caused additional pressure. And so we're probably really rolling into our harvest lows, and hopefully we can see some rebound in these prices. But we're not going to see a lot of uptick without a major revision downward in either acres or yield, given the latest report. Just turning to basis real quick. Basis is also pretty weak. So typically, um, well, right here, Aberdeen basis is actually kind of improved here. So we're at minus 43 cents on corn. Our average is typically minus 58 cents, you know, so that's a little bit better. And right now, basis should be a little bit better. This is you're in your summer months. This is when the local supply is the tightest. You should always have above average basis. But if you look at the going out to November or December basis, these are going to be weaker than averages when they're expecting this larger crop. But you can definitely keep track of where basis is. One thing about basis at the Gulf of Mexico right now is actually really strong. So that's suggesting that with these cheaper, lower grain prices, there's a lot of interest from importing nations to, bring that cheap U.S. corn to their markets. So that's why Gulf basis has increased here recently, because there's a lot of additional increase in export demand looking to get that corn pulled down to the Gulf and port locations so they can bring it into their country. And so that's why we see this Gulf basis spread, and the difference between interior basis and Gulf basis widen a little bit. Now turning to soybeans, the soybean picture is a little bit better. We're seeing a reduction in acres, so that 2 million acres that they added to corn was actually reduced or taken away from on the soybean balance sheets. So more people went corn on corn and less corn soybean rotation, and so that's why we see a reduction in soybean acreage. So about 2.5 million acres less on that. Yield went up, so that kind of somewhat offset that acreage reduction. But overall, we still are seeing a smaller soybean supply than we were expecting, say, last month. So about minus 43 million bushels less in soybeans than the previous month. And so just a historical comparison, the 80.9 million acres of soybeans is quite a bit less. We'd have to go back to about 2018, 2019 to see that small of a planted acre for soybeans. Yields pretty high, relative historically speaking. And so those are all kind of important indicators. So smaller supply on the soybean side really is a result of those smaller acres. Now, as we turn to soybean demand and what USDA did on changes here in the last report, basically held crush the same at 2.5 billion bushels. They actually lowered or what they think for exports in this upcoming year by about 40 million bushels. So overall, use went down about minus 43 million acres, and supply went up 40 million bushels. So really just no change ultimately in the ending stocks to use situation for on the soybean side, because any decrease in supply, we saw a decrease in demand and so forth. So if we look at, on just a nominal basis, our ending stocks here for 2025, 2026 being forecast is about 290 million bushels, which is fairly small. And then when you look at it, a percentage relative to expected use, it's, we had these big soybean stock levels over the last couple of years because we had a lot more soybean acres. And we built those stock levels up, and they were kind of overwhelming on bearish on the market. But now we're seeing that drop back down, or is forecasted to be dropping down through this next marketing year back to more of a, a bullish 6.7%. So this soybean overall is probably neutral to more bullish from the two right now. And even though we had this expected 6.7 stocks to use ratio, we're way below where we would think we would be trading on an average futures price for that level. Actually, given we would given that 6.7% stocks to use, we think should be trading around $12.30 if you look at the historical relationships. But right now we're trading about 961. So a lot of this could be related to, just uncertainty about tariff, and the trade wars and whether we're going to be able to export to China because there's still that 30% tariff thing hanging out there, and we kind of extended it, but there's no real resolution to all that. So there could be that pressure of, we just don't know if we're going to have a big export market. And soybeans, this planned estimate of huge crushes, we just haven't really seen domestically because they're trying to incentivize more domestic crush for renewable fuels in the biofuels market, but it just hasn't really materialized over the last couple of years. Currently, for exports, with a couple more weeks left, we have about a 1.78 billion bushel export number right now for soybeans. That's about what we're expecting for next year. So we would have to see the same type of robust or that same type of demand level for export in order to meet next year's forecast and get to that 6.7% ending stocks to use level. Obviously, the big destination for soybeans, U.S. soybeans and South American soybeans, is China, followed by a long distance second is Mexico, Egypt, and so forth. So, any type of trade war issues with China on a political front could cause, those exports to be lower. And vice, on the flip side, if we had a good trade deal or we created more demand from China, then that could be certainly bullish to prices on the export front. As we look at the production analysis for South Dakota, right now we had last year we had a 47 bushel per acre yield. We're looking at a 47 bushel per acre yield this year so far, according to USDA. So nothing's really different there. We have 200,000 or about 300,000 acres less of soybeans in South Dakota. So going from 5.5 million to 5.2 million. So less soybeans expected to be in this local area, given the less planted acres. And so that is somewhat helpful for local demand and whatnot. Currently, right now, we're trading about 10.15 on futures. The 52-week high was 10.80. Back here in again early February. So if you made those trades then, and you would have been doing real good. Again, in that March period, we had all that trade scuttlebutt, and then there's been just different aspects of trade concerns, and then we've really had kind of a bearish thing with more mild August weather, which usually tends to increase soybean yields. But since that August or that WASDE report came out on Tuesday, we've had some pretty good positive days on soybeans. Right now, the upper Bollinger Band here is showing about a 1035. So at 1035, you might want to look at in the short term doing a little hedging or selling some out of money calls at that point, and just to try to build on price and see where we're at. But really, we're at about a pretty good neutral trend on soybeans around this. It's very fundamentally supported given a 6.7% stocks to use levels. So I don't see much more of a downside on soybeans as long as we can keep that demand going and we can get down to that 6.7% stocks to use. Now, as we look at basis, Again, these are the summer months, so soybeans are tightest. We should see current be above average, for the whole year, which we do. But if you look at the deferred basis contracts, you'll see that these are pretty weak actually for harvest months locally. That, well, Aberdeen, Watertown, all these areas would have weaker basis pretty much. Also, just like on corn, we're seeing Gulf bases here recently show strength. Again, these importing nations seeing cheap soybeans in the U.S. want to, import those cheap soybeans, especially at this point in time of year. So the Gulf basis is strengthening and trying to incentivize elevators to bring bushels down river, down by train to export destinations and terminals, so we can get them on boats and out. And so that's why you see Gulf basis, a separation on the Gulf basis spread versus the interior spreads. So I do also have wheat that covers some of the basic same analysis, but just in the interest of time, I won't go over all of that. Happy to take any questions. And again, this is the app is at Agland sdstate.edu grain. If you want to check it out, my contact information is right here. I'm happy to hear about if you want to see other additional information in this interactive grain report. Real happy to add any type of information that would be useful for you guys to monitor. So with that, I'll take any questions or any comments.